You may often perceive trading options as the buying of calls and puts. In this webinar, we'll take a deep dive into looking at the other side of the trade, selling options. Joining me today is Phil Davis, founder of philsstockworld.com, and he's going to discuss some of the key elements of being an options seller. Phil will also provide some common strategies that option sellers may implement and how they are commonly used. Welcome, Phil.
Hi, how are you?
Oh, I'm doing great, thanks. All right, so let's get started. Phil, you've been doing this a long time. What should beginners consider when it comes to options trading?
What should beginners consider? I mean, they should consider that they are learning to use tools that they did not previously work with. So in other words, you're developing skills. And when you're developing skills and getting better at trading, you should be putting more tools to bear on the situation. And as you get into options, they are the more advanced tools. Because they're the more advanced tools, though, they can also be a little bit dangerous. Just like if you move from using a hammer to using a jackhammer, they usually give you some training before you start using a jackhammer because it's much more dangerous than a hammer. You want to just sort of learn how to use these things, though. In other words, you're not going to be able to build a highway without a jackhammer. A hammer is not going to help you build a highway. You have to start learning how to use the more advanced tools if you want to build a more advanced portfolio. But you have to also be aware of the risks of using them. For example, if you're selling a put, you are obligating yourself to buy the stock of the put for this put that you're selling. So you don't enter into it lightly. A lot of people make very big mistakes by selling more options for puts than they can actually afford to buy the stock. I always tell my members, you should never sell a put on a stock that you don't fully intend to buy. You have to really want to own the stock at that price before you start selling puts. And the same thing goes for calls. You don't want to sell calls naked. You'll be shorted the stock. And we don't like doing that ever, to sell naked calls. The only time you should only be selling a call, in my opinion, on a stock that you don't mind selling at that price. But that means you own and control that stock. You don't over leverage yourself. That's the biggest danger of doing these sort of strategies.
Okay, that's excellent. No, I love that tool analogy. That's great. So just really briefly, I know you did talk about some of the risks there, and that's excellent. And you talked about some of the benefits too. We know on the selling side, there are some different parameters, and so there's obligations you mentioned. There's also income you can collect as well. So that's, a couple of the advantages, disadvantages. Is there anything else? What would you say are some of the main advantages and disadvantages of selling options? And what are the key risks you want to be aware of?
Well, I mean, there's a lot. Look, the number one advantage of selling an option, and people act like this is some kind of crazy thing that people shouldn't do and blah, blah, blah. It's the most normal thing in the world. A call option gives you the right to buy a stock at a certain price over time. So you're paying a certain amount of money to say, I would like to buy this stock in the future at this price. And the person says, okay, you agree upon that. A put option gives you the right to sell a stock at a certain price at a certain time. And so if I have a certain amount of shares at $100 a share and I sell a put option for $5 that allows me to sell that stock for $100 no matter what the actual price is, I'm guaranteeing myself for $5, for 5% of my stock, that I will always be able to sell it for $100. That's why you sell a put option. If I'm buying a put option, that's why you buy a put option. If I'm selling a put option, then I am obligating myself. Somebody else is paying me to promise to buy a stock for a lower price. But it's hard to wrap your head around this. But once you get it, you'll say, why would I ever do anything else? Because, for example, if you look at IBM was recently trading at $135, and at $135, you sell the $110 put. Remember, IBM's $135, you sell the $110 put, and you sell that put for $10. So what are you doing? You're giving somebody the right to make you buy IBM for $110. But $110 is $25 lower than the current price. So what you're saying is if IBM goes down to $110, I'm willing to buy it. This isn't a dangerous thing. This isn't complicated. This is me wanting to buy IBM for a lower price than it is now. And fortunately, there's somebody who's worried about their IBM stock going down, so they're willing to pay me $10 in exchange for my promise to buy IBM for $110 in the future. And again, remember, it's $135 today. So my net entry cost, since I'm collecting $10, is $100 net cost for IBM, which is currently $135. That's substantially below the current price. And the worst thing that can happen to me selling these puts is that I will be assigned IBM at $110. But again, I've collected the $10. I never have to give that money back, whether IBM goes up or down or sideways. I never give that $10 back. I've sold a put obligation, and the person is allowed to make me buy IBM. Now, logically, they're not going to force me to buy IBM for $110 if IBM is over $110. That's never going to make sense. They could sell it on the open market for more money. If IBM falls below $110, so even if IBM is zero, they can still make me buy it for $110. That's my contract. So my risk is I'm going to have to buy IBM for $110 in the future, regardless of what happens to the stock. And that's a reason why we tend not to use this strategy. I teach our members, we try to stick to, fundamentally sound blue chip stocks. You don't want to get stuck with a momentum stock. You don't want to get stuck with, a big movement stock like Tesla and say, I promise to buy Tesla for $500. I don't know what Tesla's going to be in 2 years. It could be $200. I can't figure out the value of that company. So you don't want to be obligated to buy it that long term. But as far as buying a stock, if I want to buy IBM right now for $135 and I plan to own it for a couple of years, it's a long-term investment for me. But instead of doing that, I can collect $10 per share for promising to buy it for $110. Then two things are going to happen. Either I'm going to get to buy IBM for net $100 in the future, or I'm going to just keep the $10 and never end up owning IBM. But since $10 is about 6% of IBM's price, that's a nice return for not owning the stock. Better than the dividend, in fact.
Oh, that's excellent. That's a great example, Phil. I like that. And that was selling a put. Okay, great. That makes total sense. I like how you could buy the stock you already wanted anyway and receive additional income to offset that cost. What about selling calls? Is that something, do you implement that strategy as well?
Of course, because it's the same thing. If I buy, so now think about, we'll talk about that in a second, I'll tell you. So IBM, same example, IBM at $135, I can sell the $150 calls for $10. Same again, $10. So what I'm doing there is I'm giving someone the right to buy IBM from me for $150, and they're paying me $10 for that right. Why are they paying me $10? Well, first of all, they're controlling my stock because they have the right to take it from me anytime, and they're not spending $150. They're spending $10 or $135. They're not spending $135 to own my IBM. They're spending $10 to control IBM, and should it go over $150, they start making money. So they're betting IBM's going to go up, but they don't have. But instead of spending $150, instead of spending $135 for IBM now, they promise to spend $150 in the future. What I'm doing is the IBM owner stock. I'm collecting $10 now, which they will never get back. This is my money to keep. They paid me for this contract, and they're taking, let's say, a 2-year contract where anytime in the next 2 years they can take my IBM shares for $150. Again, IBM's at $135. All I'm doing is saying if I make a 10% profit on IBM at $150, then I'm going to let the stock go. And it's not even 10% because it's actually $25, which is what, 1/6, about 15%. So I'm going to make $25. I'm going to make the $10 he gave me for the contract and the $15 spread between $135 and $150. If IBM for some reason goes to $180, I'm still going to have to give it to this guy for $150. He's going to take it from me for $150. And he's going to make a fortune. So from his perspective, he would buy the stock for $150 and be able to sell it for $180. He'll make $30 less than $10 he gave me. So he'll make $20, a 200% profit. That's the fun of buying an option, is that huge leverage you can get. But from a selling perspective, I'm not taking the kind of risk that guy's taking. That guy needs IBM to go up to 150 and then go to 160 before he even breaks even. Whereas I'm fine because what he's done is lowered my cost basis in IBM from 135 to 125.
Okay, got it. So is that something you can implement? I know you said you would own 500 shares of IBM and you're selling a call, you're going to get that income. I really like that. Is there something you would do in combination? Like, would you ever use a call example, like selling a call and then also selling a put? I know you've mentioned that you like both of those strategies.
Well, absolutely. Let's combine our two lessons. You know what we've learned so far. I could, for example, buy 1,000 shares of IBM for $135. That'd be $135,000, and I just cross my fingers and hope it goes up. That's what a stock player does, right? You just buy the stock, you hope it goes up. With options, I would do something different. Now, don't forget, when you sell puts, you're obligating yourself to buy the stock. So instead of buying 1,000 shares of IBM, I would buy 500 shares of IBM for $135. So that'd be $67,000. I would then sell 5 of the 150 calls, because that's my target for IBM is 150 over 2 years. I expect it to be up around 150. So I would sell the 150 calls for $10. I would also sell the 110 puts for $10. And what that's saying, when I sell the 110 puts for $10, I'm saying I'm buying IBM now for 135, but if it drops to 100, I'm willing to double down. So all you're doing is promising to double down in advance. Because I'm collecting $10 for the calls, $5,000, and $10 for the puts, another $5,000, I'm dropping my net to $57,000 that I'm putting as a cash outlay for IBM. So I'm in 500 shares for $57,000, which is $114 a share. So at 135, at the price we're at now, I'm already making almost $20 a share. I am making $21 a share. So I'm making $10,000. IBM would have to go up on 1,000 shares. IBM has to be at 145 before you make $10,000 worth of stock. But so I could lay out $135,000 for 1,000 shares of IBM and make $10,000 at 145, or I could lay out $57,000 for 500 shares of IBM and make $10,000 at 135. So I make the same amount of money, a little bit more money actually, it's like $11,000. I make the same amount of money at a lower strike price, and my average cost of ownership is significantly lower, about 15% lower. And that's how you use options to drastically improve your portfolio performance. But again, you don't do it on stocks that move too much. You don't do it on stocks that you don't want to be in a stock that's going to get bought out. You don't want to be in a stock that's going to go bankrupt. You try to avoid those situations. You want to be in good, long, blue chip stocks with large market caps doing this strategy.
Oh, that's really interesting. I like it. Even though we are capping our gains slightly on the high side, if IBM had a large upward move, like you were saying, we could still be making potential profit if IBM doesn't even move at all.
Yeah.
Okay, great.
That's the whole advantage of the key advantage of the strategy is that you make money in a flat market, and actually you even make money in a slightly down market.
Okay.
And you lose less in a down market. So there's the point is don't lose money, which is actually Warren Buffett's number one rule of investing: don't lose money. If you don't lose money, you tend to make it over time.
Yes, I like that rule. So, but if IBM does drop, we could offset some of the potential losses because we've collected that extra premium from the call and the put on the downside. But we would potentially be forced to buy more of the stock at the lower strike price. Correct?
Correct. You would end up owning 1,000 shares at now again, assuming you don't do anything, because you're not stuck. You can actually adjust these things when you feel like it, but because you can get out of the stock option and get and adjust it when you want to. It's your option. It's not the other guy's option. But your net entry cost on 1,000 shares of IBM would be $112 a share. Actually, if you got to sign the rest of the shares, versus again buying IBM right now for $135, then you're at $135. So you're $23 below the current price as your net.
Wow. Okay, great. So then you might have additional shares. You end up buying those additional shares, but you're buying them at a much lower cost, as if you were doing it earlier on at 135.
Yeah.
All right, I like it. Okay,
and
so
you're not tying
what
up
about
the cash. That's another huge advantage.
Can you say that again?
I said you're not tying up the cash. You're half the cash you were going to use is not being used in this transaction, so you can use it for having cash on the sideline. You can use it to diversify your portfolio more.
Yeah, that's great. And that's a great thing for our viewers to note too, is you're buying half of the number of shares you might have wanted to buy initially. And with that put, you're going to be able to potentially buy more shares at a lower cost, not using as much cash up front. I like that. So, Phil, what about those investors that couldn't afford the share purchases in your example at all? If you couldn't buy the original 500 shares, is there another scenario that you can use options for that would fix that?
Well, yeah, there's actually now we're getting more advanced because now you have to really start understanding what's going on. But that would be what we call an artificial buy right. It's an incredible use of leverage. I mean, you're using the power of options and leverage to their max. And again, going back to the IBM example, because we use the same stock, if instead of buying 500 shares of IBM for 135 to start the trade, you're going to buy 5 IBM $120 calls. And those calls cost $22. Remember, IBM's at 135. You're buying the $120 calls, so they are $15 in the money, and you're buying them for $22. So the premium that you're paying is $7 of premium that you're paying when you purchase it. That's you buying the option, which we tell you not to do. Don't buy naked calls. Why? Because you're paying that $7 premium, and that $7 premium will absolutely be zero over time. It will absolutely go to zero. You're just giving that money away. So why are we doing it in the artificial buy right? That's because we're going to turn around and sell those 150 calls, the same ones we sold before in the other example. We're going to sell them for $10. Now, the 150 calls, since they're out of the money, and IBM's at 135, and now you're selling the 150 calls, those are 100% premium. So what have we done? We've paid $7 of premium to own the 120 calls, but now we've sold $10 of premium on the 150 calls. So what does that mean? That means we bought the 120 calls not even for zero premium, but we got a $3 credit. So we've actually bought the $120 calls for a net cost of $12. And that means we paid net $132 for IBM. So now, instead of having the stock for $135, we paid net $132. If IBM goes down, we will lose the same amount of money on the way down as somebody owning the stock. We're going to lose money just like a stockholder will lose money. But on the way up, we will make money like a stockholder makes money all the way up to 150. So in other words, our net $12 investment at 150 would be worth $30, and we would make an $18 profit, 150% profit at 150. And again, when you multiply that by 1,000 shares or whatever, you're making the same amount of money you would make if you had bought the stock. But in this case, we are committing on this trade so far $6,000. It's $11,000 to buy the calls. Then we get a $5,000 credit for selling the short calls, the short 150s. So our net cost of entry is $6,000 on a $15,000 spread. So your upside potential is $9,000, is 150%. Now, if you combine that strategy with the short puts, remember you still want to buy, I still don't mind owning IBM for a net of $100, right? So now I can sell the short 110 puts for $10 as part of the same spread combination. That's going to pay me another $5,000 for promising to buy IBM. Don't forget, I don't own IBM at all right now. and I've only tied up $6,000 in the spread. So then I'm going to say, okay, I will now collect $10,000, promising to buy IBM for $110. So now my obligation is essentially buying IBM for $110, which I don't mind doing. It's at $135 now. But now I've dropped the net cost of my spread to $1,000, and it's still a $15,000 spread. I can now make $14,000 on a $1,000 outlay. But don't ever forget, I have my obligation to buy 500 shares of IBM for $110. So
okay.
as long as you really want to own it for $110, I don't have to use any money. You know that you're using the margin, obviously, for the obligation of potentially buying the stock. But as far as cash, $1,000 cash does the whole trade.
Wow.
So in the previous example, we had $57,000 tied up, and now we're taking $56,000 of that off the table.
Right. So, and as you had mentioned, yeah, you'd want to have the cash or at least the available margin, and that's something that's going to be part of your margin account where you're not going to be able to do this trade unless you have the ability to cover that amount. Is that correct?
Yeah, I mean, obviously, if you had the cash to do the cash trade, you would have the margin to do the margin trade, and hopefully, if you're in a most margin accounts, it's going to use a lot less margin than the cash would have.
Okay.
But never forget. Again, like I said, don't ever consider them two different trades. You have the put selling trade, and you have what they call the bull call spread, and they're two different trades. You can just do the spread. And that spread is fantastic. It's a $6,000 spread that can pay you back, what do we say, $15,000, 150% profit. Mm-hmm. That's with no margin and no specific obligation. So that's one great way to do. But if you really want to own, if you're ready, willing, and able to own IBM for $410, then there's no reason not to sell the puts. And the puts... effectively, look, in my mind, I don't see IBM going to 110. Even if the market crashes, I'm very sure it's going to recover and go over 110. So for me, it's a very safe bet as far as my actual desire to own IBM for that price. It's like selling AT&T for $25. It's like I really feel AT&T is not going below $25. So if I sell a put that obligates me to buy AT&T for $25, free money. It's not, I don't believe it's a problem to own it, but still you should be prepared to own it because we have seen 40% market corrections. Even the best companies get killed in a major correction. So don't ever think it's never going to happen. You've got to have the money for it in your portfolio.
Absolutely, yeah. We know anything can happen, right? That's one thing we definitely want to remember. And so this example you just gave is very similar to the other one, but we're not using the stock, in the sense that you can make money on the high side. You're still going to collect those premiums and that income even if the stock doesn't move. And then if it does drop down significantly, we want to be prepared to buy the IBM stock at the lower strike, right?
Yeah, for sure.
Okay, excellent. Well, this has been great, Phil. Last question I want to take you through is, are there any overall tips you would give investors like as their first steps if they are going to jump up to these advanced tools? If we're going from, say, the basic hammers and screwdrivers up to the more complex tools?
Yeah, I'd say the most important steps, I think, is you've got to do this you got to paper trade these first. You really should spend at least I'd say a good 6 months. You want to paper trade these strategies and just try it without actually jumping in with both feet, or just start small. Just try it with a few. Don't go crazy. It's very, very attractive, but again, if you don't do it right, you can screw up and end up assigned a lot of stock you didn't really want. You have to you have to practice very serious allocation strategies, and that's something we talk about a lot at PSW. Is we talk about portfolio allocation strategies. In other words, if you have $1 million portfolio, let's say, you should really break that up into 20 allocation blocks of $50,000 each. And so no trade should go outside its allocation block, and that means you have $50,000, and let's say you have a portfolio margin account. It allows you to trade $2 million worth of stocks. So then your allocation blocks would be $100,000 at the most. But just like any portfolio margin, you have to be careful with it, but you should manage it that way. But in other words, you should never let a trade exceed an allocation block, and you should also scale into those. So you should start off with a 1/3 or 1/4 allocation of a block and then build from there. And that's how you keep yourself out of trouble. So in other words, no single stock should be more than a full allocation block, no single position, no obligation for position. And also you should start off with quarter positions or half positions to make sure that you are on track and building something solid before you start adding too much to any single position. And you can do that and build it up over the course of a couple of years. And we have, in fact, we have a portfolio we run for BNN on another show on Money Talk that's a portfolio. And we show people these strategies all the time and say, here's how you build a portfolio over time. And they still get spectacular returns because of the way you're using the options. But just don't rush into it. Don't go too fast. You want to just go in, scale in slowly, build your positions over time. Like I said, selling the IBM put, for example, right? You're selling a 110 put 2 years out. You're not going to win that position until 2 years have passed. So that's your first allocation goes to that.
Okay, great. So it's kind of baby steps into these more advanced strategies.
When you're starting out, until you're comfortable with it, baby steps is best. And even, frankly, even when you're a pro, I mean, I still have to rein people in. I still have to tell our members sometimes, I'm like, it's a little too many. It's like somebody says, I got 30 of these and 20 of these. I'm like, whoa. I'm like, unless you have $100 million, let's calm down.
Moderation is the key, right?
Yeah, this is, we're talking that example of IBM, 150% return without using margin. I forget what the number was, 1,400% return on your cash if you're using your margin. These are crazy, crazy returns. You're going to build your portfolio up very nicely if you do these things correctly. But they can also go the other way on you if you do them incorrectly. So take the time, learn how to use it properly, and have the right tool in your portfolio for the right moments when they come.
Excellent. Well, thanks so much, Phil. I think that's all the time we have for today. We're going to still have you here for some questions to answer. So everybody stick around and we'll start the Q&A.
All right. Well, thank you very much.
Thank you.